Hello, everyone, and welcome back. Thanks for joining. Our topic for this video is going to be escrow account for mortgages. Now, in general, what is an escrow and how does it work? Do we want or need one? And overall, how will that account influence our mortgage process? And guys, remember, if you're enjoying the videos and the content, please remember to subscribe to the channel, like and share it, and also comment for any additional items and information you want to add to those videos. So let's start with the word escrow. So escrow is an account that's linked or connected to a specific financial account, and its purpose is to collect money for a specific reason set when the account was created. But when we talk escrow for mortgages, the only thing that account is allowed to collect is property tax and homeowners insurance, as well as flood insurance if there is an active policy in place due to a flood zone map where the house is at. Now, if we're purchasing a home, escrow can also be used to hold money from the buyer until the transaction is actually completed. So now, do we want or need one? Well, most clients build their mortgages with escrow accounts. Now, the benefits of having this account is because it's collecting a specific amount of money from the mortgage payment every month towards property tax and homeowners insurance. And then automatically, based on the due dates, it will send the money out to the county and the insurance company. And just to give you guys a quick example, a complete mortgage payment that's including escrow is called PITI. Basically, that stands for principal, interest, tax, and insurance. Now, in this particular example, if we have a payment of $1,000 a month, our principal is $150, our interest is $350, our property taxes are $400, and our insurance is $100. And again, that's every single month. So now, when a mortgage company builds the escrow for the first time, they make sure that they're collecting for enough months up front, plus they add 2 months of cushion for property tax and 2 months of cushion for the homeowner's insurance. The reason we have 2 extra months as a cushion is to avoid shortages in the escrow account. In addition, escrow accounts are not permitted to hold more than 1/6 of the total annual cost of the items it's collecting for. Any cash that went into escrow that exceeded that 1/6 threshold when the mortgage company does its annual escrow analysis must be refunded back to the client. But on the flip side, if the escrow account became short due to increase in property tax or homeowners insurance, or maybe even both, the mortgage company will give the client 2 choices. One, either pay for the shortage in one lump sum or build the shortage into the mortgage payment for an X amount of months, causing the mortgage payment to increase for that duration of time to cover the shortage. So the question is, do we want an escrow account? And the answer is yes. Most property tax due dates in the United States are usually between November and January, which falls on multiple holidays, and most clients don't have hundreds or thousands of dollars saved to easily pay for those taxes, and in some cases, insurance is also due right around that same time. So by having an escrow account, the client is able financially to save money needed to pay for their property tax and homeowners insurance every month and avoid financial trouble. Now, in addition, it's important to remember that escrow accounts can still be short on the cash needed to pay for property tax and homeowners insurance. So it's always advised to keep track of how much money is in the escrow account against the amounts that are due for property tax and homeowners insurance every 3 to 6 months. That would allow the client to catch those possible shortages ahead of time and avoid an increase in their mortgage monthly payment. Now, on the flip side, the few clients that may not need escrow are clients with property tax exemptions where nothing is due to the county, so it leaves them with just the homeowner's insurance. And if that policy is not expensive, most elect to pay it on their own. The other ones are clients that for years have had an account collecting interest for them on their own money, and over time, while that account grows on its own, they just pull out the portion of cash needed to pay for their property tax and homeowners insurance on their own. So escrow is not a special bank account at the end of the day. It simply helps clients avoid property tax and homeowners insurance issues that may cause bigger financial problems later on. And since we mentioned the word interest, escrow accounts legally cannot collect interest on the money that's in that account. That account is solely for property tax and homeowners insurance policies and also cash from buyers when doing a purchase transaction. And lastly, just to add, is that when we choose to take a mortgage without the escrow, What we do is we price the mortgage application with what's called waiving escrows. Fannie Mae and Freddie Mac will charge a higher value of discount points for electing to take a mortgage without escrow. Some mortgage companies will cover that cost for the client, and some would pass it along to the client by charging that higher cost of discount points. And that's all I have for you guys about this subject. Feel free to add anything else in the comment section about escrow accounts and different things you've experienced with those. Please remember also to subscribe to the channel, like it, share it, and I'll see you on the next one.